Hi, everyone. This is Jason Burack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He's a hedge fund manager and financial professional. He's been managing money and investing and trading for over 20 years now. He also has a new product. He has the Coffee Can investment newsletter. I'll let him talk about that later in the interview. Kevin Duffy of Bearing Asset Management. Thank you for joining me again.
Thanks for having me back on, Jason.
Yes, and this is the exact time to have you back on because you've made a lot of money over your career, over 20 years now. You've been through a bunch of different bear markets, and here we are. We've had an enormous stock market crash in the last 4 or 5 weeks, and it looks like the Fed's trying to engineer a bear market rally. Do you think that this scenario right now is as bad or worse than 2008?
I think it is. It's very different. 2008 was really. I mean, if we look at the last two bubbles, the previous two bubbles, the tech bubble and the credit bubble, they were more sector specific. This one has been called the everything bubble, and it's extremely broad. The level of and it's been different. You know, every bubble has its different characteristics, but this one's certainly been. I think at the epicenter of this has been a bond bubble. That's really the key difference between the everything bubble and the previous two. And I think what's interesting is that at the core of that, the epicenter of the bond bubble is really a sovereign debt bubble. And we actually saw that bubble get bigger as the stock market was selling off in late February and through mid and late March, went down 33%, and people were basically jumping out of that bubble and into the bond bubble. So I think that's one of the things that makes this bubble very different than the 2008, 2009, because in the previous two bubbles, there were really places to hide, and this time it's very difficult. I guess back in 2008, 2009, you could have owned Walmart, for example, and Walmart is pretty expensive stock. Some of these defensive stocks are really quite expensive now. So I think the levels of leverage are certainly much higher, and the government debt has gone up much more. Corporate debt has doubled. You have student loan debt. You have auto finance debt. You don't have quite as much mortgage debt. You know, it's different, but I think this is just on a much greater scale than the previous two bubbles.
Yeah, I agree. It's more all-encompassing, and in 2008, the governments and central banks took a lot of the liabilities from the banking system and the private sector onto their balance sheets. So who's going to bail them out then?
Exactly. We're going to find out. There's a sense that the federal government has unlimited resources. And I think we've seen this with modern monetary theory, the idea that we can just print money until the cows come home. And, you see what's going on. There's a certain moral hazard with the stock market, the idea that every dip should be bought because the Fed would come in and save the day. Well, you see a similar moral hazard, I think, with the state and local governments right now, with the shutdowns that are going on with regard to the coronavirus. I think there's probably a feeling that no matter how much damage they do to the local economies, that the government is going to come in and bail everybody out. So I think this is a big part of what's going on today.
Exactly. The lack of economic activity means that the state and local governments, all the cash flow projections that they have from people eating out at restaurants and buying at stores and going to bars and ordering some drinks, all that tax revenue that they were counting on is temporarily, at least, who knows how long exactly, but it's gone.
Yeah, it's gone for now. There's no question about that. And it's a question of when is it going to come back?
It seems to me that in 2008, from what I remember, a lot of the bailout programs took a long time. So some things took 6 weeks, a couple months. It took a long time for the Fed to roll out a lot of these bailout programs. They had to change the accounting rules for the FASB in March of 2009 for the large banks, so they didn't have to mark down write-off losses. They could mark to model. Does it seem that all the bailout programs, and there's tons of them, I just had Danielle DiMartino Booth on for an interview too on Friday, April 10th, and she said that she tracks the Fed extensively and that the Fed has around 40 different programs running off balance sheet and public ones. Does it seem that everything rolled out faster this time compared to 2008?
You know what? I'm probably not the best person to answer that question. It seemed like they were sort of making things up as they went along back then, but they were certainly very aggressive. And this time, I mean, I guess all I could say right now is that that the numbers are bigger. They're really grants. I just was looking at the latest grants, and they said QE2, for example, which would have been what, 2010, 2011, was something like $700 billion in expansion of the Fed's balance sheet, and this time we got that in something like 7 weeks. I think there's maybe 7 days. We're just talking about the numbers here are absolutely staggering. I was reading Mark Faber's latest commentary, and he thinks that the Fed's balance sheet in a year will be at $10 trillion. So I guess one of the things that, I'm not answering your question directly, but I think one of the things that we can see is that this idea of stimulus, the idea that you get a crack, you get a crisis, and then the response is it's constantly a greater and greater dose of the drug. So, we're now taking this to just a much greater level than what we saw in 2008 and 2009.
Exactly. The credit bubble just kept growing, though. You documented this. You were sending a lot of tweets out about the amount of margin debt in the stock market, all these professionals, and also in people's retail accounts, the level of margin debt, the lack of cash balances. You track that. And right around the top there in February 2020, right before the market crashed, there was very little cash in people's account balances in their stock brokerage accounts and record margin debt for retail and for hedge funds, right?
Yes, exactly. And actually, the statistics are provided by FINRA, and they go back to the mid 90s, I believe. So it's an interesting series because you can see customer cash and margin balances, and then you take a net number. So you can see if they're in a net cash position, which tends to be at market bottoms, the major bottoms that we've seen, and then you see a net debit position at the tops of these various bubbles. And when you look at this graph, what you see is that the tech bubble, you had a pretty big net debit balance. And in the credit bubble, that was the tech bubble. In the credit bubble, it wasn't quite up to the tech bubble levels. This one it just blows away the previous two. Now, those numbers peaked a little while ago. They actually had started to come down slightly in this year, and but we will find out probably in a couple of weeks. We'll get this data because it comes out with a lag. But what I'm really interested in seeing is the figures for the end of March. My guess is that what we saw was a massive margin call in the month of March and the end of February. And so I would not be surprised to see those margin debt figures down dramatically and the cash figures up. So this is something that I think we have to keep in mind with a bubble. What tends to happen in the beginning is you get that first crack. You get the washout of the margin traders. And I think that's what we got. We got a massive margin call. We've cleaned all that out. And then you get out of that, it sets the foundation for some kind of a rally. And that's what we appear to be having right now. What you haven't seen is what I like to call the autopilot money changing behavior. People that have their money in index funds and 401ks and long-term retirement money. The evidence right now is that money really has not budged. And my guess is that at the end of this bear market that we're in, we appear to be in, that it won't be over until we see that autopilot money start to kind of get nervous and change their behavior.
Yeah, I think some large hedge funds that were doing risk parity and the basis trade, which I've covered on my channel recently in the last couple of weeks, I think some of the hedge funds all blew up in the last 4 or 5 weeks, and there were bailouts. I have sources, one upper management someone who's a podcast listener for a long time, upper management, one of the credit ratings agencies. I do get information from him, and then also someone who's good friends with a bond portfolio manager at one of the investment banks, and just hearing some of the information from what obviously it's secondhand in one of the cases of what occurred in the last 4 to 5 weeks with the bond markets, the credit markets, and how a lot of these investment grade corporate bonds, high yield debt went no bid, and they were ordered, the bond portfolio managers and some of these hedge funds were ordered by their risk officers and their bosses to reduce their exposure 90%, be net sellers. Everyone was heading for the exits, and then there were no buyers. So Fed had to step in at some point. Otherwise, the markets were going to totally collapse.
And I think this is one of the things about capitalism and the markets that they function, I think, very well. That they reacted to the situation very quickly, and they forced a discipline. They forced a washout and a liquidation, and it took place. And at least in the early stages, it was fairly orderly. Yes, the volatility got fairly extreme, but I think it worked. You had people. It was a great moral hazard trade. It was all based on the Fed being the ultimate backstop. And when push came to shove, people realized that, you know what, they were being tapped on the shoulder by the margin clerks, and it was time to liquidate. So I think that took place, and it happened. It happened the way it should be. The problem isn't the markets, but the problem is the government is trying to override what the markets are trying desperately, the discipline, which is very healthy, that the markets are trying to impose right now, which is basically put this on a sounder footing, try to eliminate and try to reduce the debt and the leverage in the system. And these people that were basically acting recklessly, get rid of them and replace them with the responsible people. And the government, so the market is working in this direction, and the government is constantly moving in the other direction, trying to shift money from the responsible to the reckless.
And governments, central banks, they want currency devaluation. They want higher asset prices. They do not want debt destruction. They do not want credit collapsing. So that's why the Fed felt it had to step in, because they don't want all this dollar-denominated debt outside the United States collapsing. They don't want total freezes in all the different credit markets and bond markets. And that's why the Fed, I think, one of the bailout programs was totally skipping all the banks. I don't know if you saw that one, where the Fed, I guess this shows how in peril the banking system is, which the mainstream financial media is claiming is not the case. But the Fed circumvented the 24 primary dealers, and the Fed is now loaning directly to some large corporations on an exchange too.
I did not see that. That's interesting.
So I want to draw on your experience again from 2008, since you were through something similar, although I think things, like you said, are a lot worse. I agree with you on that. Talk about the rules changes that occurred to you as a short seller with you and your partner at the time, Bill Wagner, with the government and also the Federal Reserve, the government, and also the broker that you were using for your trades. Because I know some hedge fund managers were short bank stocks. They were short selling bank stocks back then, and weren't some of their trades canceled?
We were concerned about counterparty risk, so we did not get involved with credit default swaps. And I know that some of the people that had really made fortunes on that, they had a hard time collecting at the end of the day. So we stuck to pretty kind of plain vanilla. I've heard a lot of stories, a lot of war stories. There's an interview with Mark Cohodes, and I think he was using one of the big firms, maybe Goldman Sachs, as his prime broker, and they royally screwed him over. We were very fortunate because we were concerned. We were actually shorting all of the big Wall Street investment banks. So the last thing we were going to do was have money with them. It's difficult because remember the problems at MF Global. We had an account with MF Global. This was after 2008, 2009. So you always have to be worried about the counterparties. But as far as the kind of the plain vanilla stuff, the futures markets and the options markets, which is what we really relied on, primarily we were getting short through options. And those markets function very well. And you know what? They functioned in this extreme stress environment that we saw in March. They functioned very well for the most part.
Do you think at some point a lot of governments are going to start banning short selling?
I don't know. I know we talked about this before, and I'm not sure that there were that many short sellers left. I think they have maybe bigger fish to fry. I hope so. As much as they shut everything down this time, the state and local authorities kind of shutting things down, and I think this was also somewhat later in the game because we have to keep in mind the timeline where the markets crashed first, and then the authorities, sort of the local and state authorities, started shutting down things and forcing the social distancing. But the markets actually, they didn't shut them down, despite the fact that we saw. I remember one day the S&P was down about 10%, which was the biggest one-day drop since the 1987 crash. And I'll have to give the authorities some credit because at least they didn't shut down the exchanges. Of course, that probably would have caused even more of a panic. So I don't know. I mean, so far at least it looks like that hasn't happened, and I'm hopeful it doesn't happen.
Yeah, because outside the United States, some governments were either talking about banning short selling last time we talked, like South Korea, Turkey, some others. And then I think in the last couple of weeks, I think the Philippines shut down their stock market, and it backfired because then as soon as they reopened their stock markets after they shut them down, I think there was another even larger crash.
Yeah. There's not much. At some point, they just have to deal with reality.
Do you think we're going to have a lot more volatility then going forward?
That's a good question. I feel my sense is that is no, actually, strangely enough, and I could be proven completely wrong about that. It's not like I have a very strong opinion, but my sense is that we had all this leverage in the system. We had the hot money, the fast money, the traders, highly levered, and it was a house of cards just waiting for a pin. And COVID-19 came along and it provided that. And then when it went, it was the volatility was really off the charts. And then you added sort of this black swan event with the Saudis and the Russians, and overnight you get oil prices down 25%. So it was all of these things sort of coalescing together, and it created incredible volatility. Like, to put this in perspective, the VIX got over 80. I think it peaked at around 83, and which is the highest that since they've been calculating the VIX the way they do. Apparently, it's the highest reading that we've ever gotten. If you were to go back to the 1987 crash and do it on a similar basis, I think the VIX would have gotten up to something like 100. So, that sort of puts it in perspective. And the volatility, the implied volatility on crude oil got up to about 200.
Whoa.
So I don't think we just got these massive shocks. My guess is that we're not going to see that sort of craziness, and that we could have at some point maybe a slow bleed, a normal bear market. But I think the crazy volatility maybe is behind us. And then we probably, in terms of things being very volatile and uncertainty, maybe we need to be thinking sort of further many chess moves ahead in terms of when we have, say, hyperinflation. That would be, then all bets are off. Then we would have some just wild volatility and great uncertainty. But that is probably, another chapter for another day.
So you don't think that we'll have a bear market rally like from 1933 to 1937, when the U.S. federal government was also adding massive amounts of debt?
I think we're getting a rally right now. Actually, I'm not. I thought we would get a rally. I think that the case could be made that we've got sort of the first issue to deal with, which is the coronavirus and the hysteria over that. And I think you could paint a scenario where that clears up at least during this flu season, and that we have a relief rally as people get back to some kind of normalcy. I think we could certainly get a rally, and my guess is that at the end of that, the rally will fail, and we'll go into a long bear market. And I'm kind of questioning how much. I know they're going to be printing a lot of money, and I know that's going to be price inflationary. And so there's a question in terms of, in nominal terms. I think in real terms, there's no question that we will get a severe bear market, and that's almost guaranteed by the actions that have been, all the interventions that have been taking place. These are not. If you take a sort of an Austrian or a laissez-faire view of the world, if you hold that, then you see these interventions as being extraordinarily negative, which is how I'm seeing the world. And so, at the end of the day, I think it's what's easy to say is in real terms, we're going to get a bear market over the at least next 2 or 3 years.
But not every industry is going to be hurt as badly as some others. So which industries, in your opinion, do you think are going to be hurt the most still? Is it going to be, Jim Chanos did a superb interview on CNBC in the last 10 days. He was on there for almost an hour. He laid out an extensive case for why the restaurant industry, the bricks and mortars, casual sit-down dining restaurant industry is basically destroyed. They're not, as of right now, they're not getting a bailout. So do you agree with Chanos? Think that the restaurant industry is in big trouble? Do you think the oil market could get worse? What industries do you think are looking at the most painful and longest bear markets?
I always agree with Jim Chanos. I'm not going to disagree with him, and I will definitely defer to him on those areas. Yeah, the restaurants are going to be in trouble. I think that looking through all this, I'm kind of going over the whole bond market and interest rates, and you can see certainly with treasuries that rates have come down. The 30-year treasury has gone from 2% to 1.35%, and so everything else, interest rates have gone up. It's only been the U.S., the federal government, which of course doesn't make a whole lot of sense, but that's been the knee-jerk reaction initially. But then you look at municipal governments, rates have gone up maybe 0.5%, 1/3 of a percent, or 0.5%. So they've gone up a little bit. But then you get into investment grade bonds. They've gone from low 2% to about 3%. Then you get to medium grade bonds. They've gone from low 3% to low 5%, so about 2% higher. Then you get into the high yield. It's gone from 5% to over 8%. So, rates are going up. And my feeling is that despite all the interest rate suppression, that the businesses I do not want to be in right now are really heavily dependent on credit. I think that is where we've sort of crossed the Rubicon into a deleveraging, and I don't want to have anything to do with any businesses that are highly levered. So the real estate investment trusts are a good example. I don't want to have anything to do with retail REITs and office REITs. I don't want to have anything to do with any kind of a credit provider, banks, credit card companies. Just don't want to be in those types of businesses primarily. Another area that I've been a critic of for a long time has been the passive bubble and passive asset managers like BlackRock. I think, and so far that the passive bubble, I would say, is definitely intact. But the call that I'm making right now is that I think the passive bubble is peaking, and I think now is the time to be thinking about active management. And so I would avoid. I might actually be looking at getting long some of the active managers, some of the value managers, but I would avoid or short something like BlackRock.
Isn't BlackRock getting a new big fat bloated federal government contract to handle some of these Federal Reserve special purpose vehicles, at least one of their new bailout programs?
Wasn't aware of that, but wouldn't surprise me. And I think that, look, this is what's going to be going on, is that you have a lot of companies that like Boeing that got themselves into trouble, and the cruise lines and the airlines, and they're all at the bailout trough. And what I want to do is I want to avoid investing in those companies. The banks. The banks are, all these companies have credit lines, and the banks now are really joined at the hip with the government. I think largely as a result of what happened with the bailouts in 2008 and 2009. And so the banks are going to be expected to take on a lot of these and extend a lot of these loans to these zombie companies. And I just don't want to be in that business. I think that even though the government is trying everything they can to prop up these companies, I think at the end of the day, the market is going to have its way, and I think they're going to fail. And I just want to focus my energy on those companies that will survive this. I think that's where you want to be.
So what types of things are you looking for then in companies that survive this? Cash on the balance sheet, strong margins, maybe a consumer staple business. The problem with what I've seen, Kevin, with the consumer staple businesses like a Costco or a Clorox, these things are too expensive to buy right now.
Exactly. And I think it's a good point, Jason. If we go back to the tech bubble, it was simple because you had a bubble in the new economy, and you had an anti-bubble in the old economy. So you could have bought really defensive names like Church and Dwight and Procter and Gamble that were very, very cheap. I mean, they were on the discard pile. This time it's totally different. So I was looking at forward PE ratios of some of these companies. Costco, I'd love to own Costco. Costco trades at 35 times forward earnings. So, I don't want to own Costco. TJX, which is really the sort of best company in off price, is trading at 16.3 times. Macy's is trading at 2.6 times forward earnings. So, that gives you a sense for what the disparity out there between sort of the haves and the have-nots. I mean, obviously we'd like to invest in the defensive names, but they're just so prohibitively expensive. So what I've done is I've kind of looked at the whole retail landscape, and I've gone through it with a fine-tooth comb. And what I'm looking for is, we don't have any money invested in Macy's, but you could probably make a case that it might be a worthwhile speculation. But there are a lot of companies that are retailers that have exposure to the malls, that have been through the wars. They've been through e-commerce, they've been through the problems with the malls, and they have managed to come through in pretty good shape. So they're already battle tested. They've also benefited from some of their competitors going out of business. And then all of a sudden we get hit with this massive shutdown from the coronavirus. And these companies have, not only have they survived, but they've also adapted by going to the omni-channel model. And there are a number of them. We don't own all of them, but I'll mention several. Urban Outfitters, they get over a third of their revenues from e-commerce. Skechers is another one. Zoomies. They all have great balance sheets, no debt. They have a young demographic that should come. These people are just starting. They don't have anything to lose. They don't have stock portfolios that have been wiped out, and so that's been my approach right now. I think these stocks have gotten really, really cheap, and there's some really high quality companies that that I think can weather this. That even if things, I looked at some of these, and even if we were to stay locked down for 18 months, I mean, these companies can actually survive. A lot of them won't, though. A lot of them won't. And I think the longer things go on and the worse they are, that some of these companies will actually benefit from other businesses shutting down.
You are a true contrarian there, because there is blood in the streets there, but obviously there's babies thrown out with the bathwater. There was some gold stocks that were unfairly discounted in the last month or so. All the gold stocks and silver stocks were indiscriminately sold off, with the margin call that you were talking about. There are bargains, but there are, to add to another defensive stock name that should be a defensive stock, but it's not cheap, is Chipotle Mexican Grill, because I noticed this, that a lot of people, whether it's people driving Mercedes-Benz, BMW, Porsches, or middle class or millennials, are now eating at Chipotle because they have a good takeout business. So people are trading down to Chipotle Mexican Grill to get tacos, burritos, and salads. But if you look at the PE ratio is around 12. So it looks cheap from that, but it's at just under 40 times forward earnings. So It's not really cheap. It's very misleading. The share price is still, I think last time I looked at it earlier this week, was still like $700 a share. So it's not cheap.
Yeah, you just have to go on a case-by-case basis. But I think, Jason, you bring up a good point, which is we're trying to envision what the world's going to look like, the future's going to look like after all this. And so one of the things that I want to do, certainly on the retail side, is avoid kind of that high-end consumer. And I think you're right. We need to be looking at people trading down and who will benefit from all that. So
Yeah.
it's an interesting, certainly interesting environment. And you mentioned gold and silver. You look at what's going on with fuel prices, and not only with all the money printing, but we've got some trends that are going to lead towards price inflation. Besides the fact that the Fed's balance sheet is probably going up to $10 trillion, but this we've had this global, anytime you have an expanding division of labor and you have globalization, that's been price deflationary. So the shock that we've had to the system, and it may not be a recovery that happens overnight. That could lead to some price inflation. And also with all the cheap money that's been going to money-losing unicorns, that's been price deflationary. I think that game is over. So it's probably not a bad time, if you're sort of thinking about the future and what this world is going to look like and chess moves ahead, to be thinking about a world where inflation is not dead and that it could come back.
Yeah, I think the best case scenario is a lot worse stagflation here in the US. I agree. It's a common, I agree that the consumer, a lot of people who are consumers will be trading down. I just don't see a lot of people doing well financially in this environment. So I think the amount of discretionary income available is collapsing still.
It is. And that's why you just have to be really careful about what you can buy. It's very difficult. This is so much more difficult to find things to buy than say in 2007 or in 2000. But I will say that there are some real bargains. I think what's happened, because we saw some stocks get hit in March, in late February and March, that had already been, I think, at least reasonably priced. They got knocked down by 30, 40, 50, 60%. And so it's just a matter of kind of going through one at a time and looking for opportunities. But I think I think you can certainly, at this point, I feel a lot more comfortable trying, if I had to build a long-only portfolio, even if you were to take away the gold stocks, which I wouldn't want to do, but a long-only portfolio, I feel a lot more comfortable doing that today than I would have 2 months ago.
Is that what's going into the coffee can portfolio? So tell my listeners what the coffee can portfolio is.
Okay, what I decided to do was I get questions every now and then from friends and asking for advice, and I thought it's very difficult to do that because, of course, with people, especially if you give them specific advice, they're always going to screw it up. You know, they're always going to come back and say, "Well, you recommended I did this and it didn't work out."
Well,
And
normally, sorry to interrupt you. Normally people, they buy all the stock at once. So
yeah,
you tell them something, right? And then they go and whatever capital they have, they allocate it all at one time. They don't buy anything in tranches. They don't see if something drops. They just go, "Oh my God, it's going to go up." And they, but that's like the most common mistake. I get long emails about this. I'm sure you do too.
yeah, well, I don't get that many emails about it, but you know, I have gotten questions from people, and so there were a couple things that was trying to do. You know, first of all, I've got two nephews who are in their early 20s, and I thought, you know, I'd really like to write something that's kind of like a diary and a roadmap for them. So that was really the first thing, and the other is that I think that there is a lot of bad advice out there, and I think it's really because it's a way of thinking that people that are successful in the investment business have done so because they really haven't questioned the interventions by the Fed, and they've just assumed that they will always come in and rescue everything and prevent really any kind of pain. And I
Yep.
thought this was a wrong mindset because it's creating moral hazard. And at someday, it's kind of like the economy's immune system has been depleted by all the stimulants and painkillers. And at some point, it would not be resistant to some kind of a virus, to sort of mix metaphors there. And so I thought that people are used to, you know, success in the investment business equates to basically taking a very conventional view of the world. And I thought at some point this is going to fail, and a lot of people that are friends and family members that I care about are going to be lost. You know, they're not going to really understand. Well, wait a minute. My investment advisor is telling me to stay the course, or telling me that that the Fed is intervening and they're coming in with trillions of dollars and this should take care of it, and it's not working. So I wanted to try to give them a different sort of a roadmap. And then finally, what I was hoping to do was I thought there needs to be some accountability. So I wanted to actually create an actual model portfolio and and try to show how this could actually work in real time, and give people that, because you have a whole group of do-it-yourselfers, and I thought, well, let's try to give them some actual practical advice that they can apply, whether they copy the coffee can portfolio perfectly, or whether they incorporate some of those ideas in what they're doing.
Yeah, it's the BTFD crowd, the buy the freaking dip crowd, that was saying that, oh, the stock market was guaranteed to rally after stock market crash. So 3 weeks or a month or 2 months from now, the stock market will be almost back up to the levels before it crashed. I was hearing that a lot last month. Now, not everyone, but a good amount of the mainstream financial professionals and CNBC and Bloomberg are still bringing those people on, whichever, I'm sure it's a minority now, whichever people they can still find to bring on TV to say that narrative.
Yeah, you know what? You're a better man than me because I try to turn off the CNBC. But you know what I have seen is, I'll have to admit, as somebody who looks at sentiment, the swing in sentiment has been quite extreme, and it's not across the board. I think it's certainly more in terms of the traders. I think the autopilot money has essentially stayed the course, but it's that sort of that marginal trader type. they went from extremely bullish to extremely pessimistic, and they went from basically buying the dip to not trusting the rally, and which leads me to believe that at least in the short term, that the rally probably has a little ways to go, and maybe we rally for another month or two. I don't know. I wouldn't bet the ranch on that, but certainly a scenario that's worth considering.
Yeah, we haven't gotten a lot of earnings yet for Q1, so I suspect that those earnings announcements are not going to be pretty. So that might dampen anyone who was thinking that this stock market rally is going to be more. But then again, the Fed could also come in, or these other central banks, and there could be new bailout programs. The Fed could, maybe, this is hypothetical, we'll see what happens. Trump just said the student loan payments are delayed another 6 months. Maybe eventually they wipe those clean. Like you said at the beginning of the interview, we're in MMT QE territory. The Republicans, after claiming for the last 2 years they wouldn't do MMT, they folded like a lawn chair as soon as the asset prices fell.
Yeah, well, I think the end of Q1 and Q2, a good part of Q2 is going to be the kitchen sink, and my guess is that people will be looking over that into what comes afterwards, and so my guess is that that a lot of these companies will get a pass, and I think what we have to be looking at is beyond that. That what does this economy look like 12 months from now, 18 months from now? So there could be a window. There could be this sort of relief window, and where investors give these companies the benefit of the doubt, and they really, I'm going to say, maybe not hold their feet so much to the fire because this was a black swan event. It was beyond their control, et cetera, et cetera. And of course, it's going to be a great excuse for these companies. And I think our job as investors right now is to try to look at what does this world look like 12 months from now, 18 months from now. And then I think what we've got to do is sift through these companies. Which ones are going to be around 5 years from now, 10 years from now? Which ones can you emphatically say, I have no doubt that they'll be around? And which ones, I mean, I look at, and not the companies necessarily, but the shareholders. I mean, this is what's going to happen is I look at a stock like Boeing. Boeing's not going out of business, but with all of the debt that they have, despite, I'm sure they're going to get lots of bailout money, despite all the advantages, I would not be surprised if at the end of the day, the shareholders get left with nothing, and that you just have the creditors take over the company. You have a clean balance sheet and a new set of owners and a new set of managers, new set of people running the company. So that's the process I think that we're going through.
Yeah, there's only a couple things right now that I'm confident in. I disagree with you. I think there's going to be a lot more volatility because some people do want a stock market rally, and the central banks will try harder. But the real fundamentals of the economy, until we have a recovery from the coronavirus and things are somewhat close to pre-coronavirus levels, there's going to be a lot of volatility back and forth, bulls and bears fighting it out. So I think the Fed wants to devalue the dollar. So volatility, the Fed wants to weaken the dollar. I think that's going to be a very common theme. But you have all these other central bankers who also want to weaken their currency, and then all the dollar denominated debt that has to be dealt with. So that's a problem. I am very confident about the gold price. So I think the gold price is headed, the timeline for $2,000 an ounce gold has moved up a lot. I don't know if it's going to be a couple months from now, 6 months or 12 months, but it's the gold price is going a lot higher now based on what all these central bankers are clearly wanting to do. And in the oil market, because at some point the demand is going to stop collapsing. Hopefully the demand is going to stop collapsing, and no one who produces oil can make a profit right now. So either all the oil companies are going to go bust in the next 6 months to 12 months, or a year or two from now, maybe 3, the oil price is going to have to be higher. So the timing on the oil market, I think, is tricky, because I think in the short term, I think it's still a falling knife, and I'm not long any oil stocks. So for the short term, I think oil is going to head lower, but that means in the long term, with the demand destructions creating supply problems in the future, I think oil is going to go higher.
Yeah, and I agree with that. And look, I don't think we're that far apart in terms of the volatility. I think what I was trying to say is that we peaked at an 80 VIX, and I don't see that we're going back to the days of a sub 15 VIX. And right now, the VIX closed yesterday at 41. And could we get into a world where the VIX ranges from 25 to 50? That's kind of what I'm thinking. But to your point about if we get into serious problems with the dollar, eventually hyperinflation, then all bets are off. Then you're looking at certainly a high volatility environment.
Excellent. So if my listeners want to follow you either on Twitter or take a look at the Coffee Can portfolio, you said you're offering the first issue free and that eventually it's going to be a paid newsletter. How can they do so?
Okay. They can follow me on Twitter at Kevin Duffy 1929. You can email me, duffy@bearingasset.com. And I'm working on setting up a website right now called thecoffeecanportfolio.com.
I think it's a really good idea. I wish you the best. There is a lot of bad paid newsletters out there. Unfortunately, a lot of them are for junior mining stocks, companies with no cash and that are doing promotional YouTube videos and paying newsletter writers to pump the stock that's not being disclosed. So, good, honest people that are giving their information and companies that actually have cash that can maybe make money in this environment, or if things improve a little bit, can make a lot of money. I think that's a lot better than speculating on some of these junior mining stocks that some of them are frauds.
Thank you.
Well, I enjoyed our conversation, Kevin. Thank you very much for your time, and I look forward to speaking again in the near future.
Thanks for having me back on, Jason.